Welcome back. Hey, look, my friends, it is that time of the year again. We are looking at the Q1 2023 updates. So, look, I want to go through the Medical Properties Trust, look at some of the numbers, what's been going on. It was a relatively uneventful quarter. However, I think there's still a few important elements there. I'm going to be digging into some of the details, including the supplementals, to really figure out what's going on here and what this means for investors. So look, stick with me to the end because I'm also going to be covering off some of those key metrics and key actions to be watching over the next several quarters of the next year. So stick with me to the end. Let's get into it now. Okay, now the normalized funds from operations, the NFFO, that was coming in at about 37 cents per share for the quarter. Now, the AFFO, the adjusted funds from operation, that's my preferred metric for looking at dividend coverage. Now, this was coming in at 30 cents per share for the quarter. Is this a surprise or is this more or less in line? Well, it is within their narrowed guidance that they were giving us in the previous updates, and it's looking like it's towards the lower end of that range of $1.50 to $1.61 NFFO that they provided us. Now, that lower end of the range, that is assuming that absolutely no rent is collected from Prospect in 2023. So that is, I think, quite a conservative element there. Now, it is important to note that they haven't actually collected anything from Prospect over Q1 as well. We'll get into that a little bit later also and the implications of that. But it's also really important to note here that the management team is very, very clear that they believe that they're going to actually recover 100% of both their investments as well as a missed rent from Prospect. And there's a number of different transactions that they have in the pipeline at the moment to try and achieve this. However, what they are not clear about is whether or not these funds are going to be received either this year, next year, and so there's a little bit of uncertainty there. And I think when we think about the stock market actions, the stock price declines here are probably reflecting a lot of the investor unhappiness with this uncertainty. Right, now the dividend. So I think the dividend coverage at the moment is very, very tight. But one of the comments and chatter I've seen is, should MPW be cutting the dividend? I think there's an argument here that that could certainly be something that they could look at, but I don't think we should be too hasty here, my friends. I think that cutting the dividend here and then trying to buy back the shares is really like trying to brush my teeth with a fork. It's just not going to really make a lot of sense. However, if they are going to cut the dividend and pay off debt, I think that could be a smart move, depending on the situation that they find themselves in. At the moment, I think they'll be doing what they can to avoid cutting the dividend. We've seen that with quite a number of stocks recently where they've been cutting the dividend. It does make shareholders rather hopping mad, and I think that would also then consequentially leave them for a very long time with a negative impact on their overall valuation. So I don't think that we're going to see this. I think they'll be doing what they can to avoid, dealing with this issue and cutting the dividend in this way. I personally think that cutting the dividend and buying back shares is a little bit unusual because they're still paying out cash, whether it's in the dividend or using that shares to buy cash. It's kind of irrelevant from a cash flow perspective. Now, this is a business. The cash flow perspective is important because in each case, it represents the money leaving the company's coffers. So it's really, really important to think about that. What I think we will see, and I think when we look at the actions that the company is taking, instead they are looking at debt. Okay, let's turn now, let's have a look at MPW's debt. Now what I've done is I've just highlighted here some of that debt. This is both variable rate and it's maturing in the next 2 years. So this is sort of near-term debt. This is debt, I think, where we're going to see higher interest rates in the near term. And this is the debt that I think the company should be paying off immediately. Are they on top of it? I personally think they're doing a good job here. Now, what they've been doing is they've been taking a number of different initiatives. This is going to result in about $1.4 billion in proceeds. They've got about $300 million of cash on hand. Now, if you think about what this means, they're going to be paying most of their Australian dollar term loan off, and they're also going to be significantly, substantially reducing the revolver debt. Now, they're going to take this down from about $1 billion, I think it is, down to about 200 million. And on top of this, that is excluding any recovery that they're expecting from Prospect. So when we reframe it this way, they're not looking, I think, at this point to cut the dividend. However, they are looking at the debt and the implications of debt in a high interest rate environment. They are going to hammer this variable rate debt, and they're basically going to be looking at reducing and paying off, my friends, not refinancing, but paying off all of this debt that matures this year and next year to the end of 2024, basically in one move. Talk about a power move. That's what I like to see. Okay, so what's sort of going on here? Okay, again, let's forget about refinancing. They are paying off their debt. Now, what this should leave them is with quite a big chunk of cash. It's going to improve their debt to EBITDA ratio. It should be then lower than 6.5 times. And if you actually look back at what the company's been announcing, this is their long-term plan, even before the big run on the stock prices. So when we think about it, what's all this fuss about? Why are they thinking, or why is there so much chatter about a dividend cut? Okay. Now, if you look at this, each quarter they're paying out about $174 million in dividends. Now, what would happen if they actually reduce this dividend by 25%? Well, that's going to be about an extra $174 million a year. Let me ask you, is that really a meaningful amount on top of the $1.4 billion in asset sales, on top of that, $2 billion in debt repayments over the next year and a half or so? I personally don't think that's enough to make any substantial difference. Now, we could double that. They could cut the dividend by 50%, and that's still only going to plough back $348 million in the year. Again, that's not a very big sum on top of those asset sales, on top of that debt repayment. It's really not going to move the needle, and that, my friends, is why I do not think that we're going to see a dividend cut. I don't think that's on the plan, and I don't think it would be particularly helpful for the organisation at this point. Look, their Q2 dividend is not going to be changed. But what we are going to see with the reduction in the funds from operation available, we're talking about, again, reduced rent collected, we're going to see very, very poor coverage for Q2. That was anticipated. The company's already, given us the signals. They've already told us that this was going to happen. So don't be dismayed about this. Do not be too worried about this. They actually do have a plan. It's a longer term plan than Q2. As I said, we're looking at some serious debt reduction, and that's going to be some serious help to the company. Look through and look past this near-term worry. Medical Properties Trust does have a long-term plan. They are, yes, facing some challenges, but I do not think that these are fatal problems. The company does expect to cover all of their rent and actually recover that contractual rent from both pipeline and prospect. Their rent coverage is stable. I do not think the world is ending. When we look back at this time in a couple of quarters from now, in a year or two from now, we're going to see that this was a really nice time to be picking up shares at a good price. Keep an eye on the rent collection. Do keep an eye on whether or not they are actually able to recover that contractual rent. Again, if they're not able to cover that contractual rent, I don't think that is a serious problem. However, it will put a bit of a damper on their long-term growth prospects if they can recover that rent. Now, hit me up in the comments below. What do you think about this Q1 update? Does it change your investment thesis at all? Are you happy with the company's plans and how they're executing on these plans? Hit me up in the comments, light it up, let me know what you think. Let's get into it, my friends.